Inside Washington, the regulatory landscape is defined by a persistent turf war. The SEC and CFTC remain locked in a dispute over token classification, while the Genius Act has left stablecoin requirements fragmented across state and federal lines. 4,000 miles away in Frankfurt, a different reality is unfolding. While the U.S. markets wait for legislative clarity, a unified financial master plan has already entered full-scale execution across the European Union. This second renaissance of finance does not rely on a single breakthrough technology. Instead, it is built on a rigid, continent-wide rulebook that dictates how assets are listed, how they are custodiated, and how reserves are verified. By enacting these standards today, Europe has established a legal environment designed to attract the global institutional liquidity that is currently stalled by American regulatory uncertainty. The foundation of this system is MiCA, the Markets in Crypto Assets Regulation. As of 2026, these rules are fully enforceable law across all 27 member states, setting mandatory standards for everything from governance to capital adequacy. The most effective tool is passporting. Once authorized by a single national regulator, it can immediately offer services across the entire market. This contrasts with the American model of regulation by enforcement, where firms discover their legal status through multi-year litigation rather than clear authorization. Institutional capital prioritizes structural clarity. By providing a predictable legal environment, MiCA has secured the foundation required for the next layers of the financial stack. Above the regulatory layer sits the sovereign layer, controlled by the European Central Bank and its leadership. The ECB is moving to protect European monetary sovereignty. As physical cash usage declines, there is a growing risk that the Eurozone becomes overly dependent on foreign payment providers and dollar-denominated stablecoins. To counter this, the ECB is deploying the digital euro. Through projects Pontus and Appia, the bank is making tokenized central bank money available for the instant settlement of wholesale transactions. The digital euro functions as a sovereign anchor for the monetary system, ensuring that public money remains accessible and usable as the economy moves entirely on-chain. At the application layer, traditional banking infrastructure connects to this new digital architecture. DXC Technology has integrated Ripple's digital asset rails into its Hogan core banking platform. Hogan currently manages over $5 trillion in deposits, and this integration allows banks to use XRP and the RLUSD stablecoin for settlement without replacing their existing software. This transition is already reaching the retail level through Germany's second-largest bank, DZ Bank. DZ Bank has launched a digital trading platform for its network of 700 cooperative banks. Millions of retail customers can now trade assets like Bitcoin, Ethereum, and XRP directly within their existing banking app, with custody managed under the MiCA framework. In parallel, the Banque de France has explored the XRP Ledger for its speed and scalability, testing it as a possible technical foundation for digital euro transactions. Ripple has become a primary architect of this transition, providing the underlying custody and payment technology that powers the European financial stack. In 2026, the European architecture is a complete synthesis of public law, sovereign money, and private sector rails. It is a fully operational digital hegemony that provides the safety and efficiency that institutional markets require. The United States remains in a state of high vulnerability. While Washington debates the specific wording of future legislation, global liquidity is already moving towards jurisdictions that have completed their homework. This gap in policy is no longer just a domestic disagreement. It is a strategic opening for the euro to challenge the dollar's role in digital finance. Global capital flows inevitably to where it is legally protected and structurally integrated. By standardizing its markets early, Europe has made itself the path of least resistance for the world's largest financial firms. The July 1st deadline for exchange authorization is approaching, and non-compliant stablecoins are already being delisted across the continent. The standards are set. Is the platform holding your assets authorized to operate under the new